Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 13th of March. We have Brent crude oil trading this morning a little bit higher, up 0.75% in early trade in Asia at $82.53. The vibrations in the market seem to be increasingly moving between tighter bands, relatively stable oil market at the moment. Stable is one word, boring's another. I mean, it's generally in that tight band between high 70s and low 80s, and even now it appears to be even tighter. Let's kick off this morning with Neil Atkinson, former head of oil markets division at the IEA. Neil, your thoughts on this sort of doldrums period of the oil markets this late into the first quarter, and we're going to see a breakout now into the second quarter as the seasonal oil demand picks up and we've got continued tight supplies from OPEC.
Well, good morning, everybody, and thanks for the question, Sean. I spent 19 and a half years working for a national oil company, and I can tell you that a price range such as we're seeing right now, a stable market that we're currently seeing right now, this was the kind of thing we used to dream of. It's not boring at all. This is how life really should be. Oil is far too important to have excessive volatility. And the fact that we are in a fairly stable range at a price which is not, it appears, having deleterious effects on demand, because growth seems to be pretty strong, and the revenues that the producers are earning, because producers have feelings too, those revenues are pretty strong. So I think it's a Goldilocks price. It's good for everybody, and I don't think it's boring at all. And in fact, if the price stayed at $82 every single day for the rest of this year, I think it would be, champagne all round.
Robin Mills, CEO of Camar Energy. Will that happen?
I think that's something we always have to be aware of, Sean. When the oil price has been stable for too long, we start getting nervous. Agree with Neil. This is the Goldilocks, but Goldilocks doesn't stick around forever. I think for now, though, we are seeing this balance of the bullish and bearish factors. Remarkably in balance, really. We've seen the short covering the past few days reducing, but not much generation of new bullish positions. So not really any kind of market-driven catalyst prices to go higher from here. I think we'd have to see a change in the fundamentals. Outside that, I think we're set for some stability for a few weeks, if not months to come. Later in the year, perhaps, is where we need to look for a more decisive change.
Salah Yilmaz, Senior Energy Equity Analyst at Bloomberg Intelligence. Salah, your thoughts, and welcome. I believe you've got the latest Bloomberg Intelligence survey results that will tell us all the answers to these questions that we can only pontificate on. Your outlook and the results of the Bloomberg Intelligence survey.
Yeah, I mean, I share a very similar outlook, and I'll share what the survey told us in a second. But I think, as Robin mentioned, it's remarkably a balanced market where I think on the one side we have the tight grip by OPEC Plus on supply and the geopolitical risks, which haven't really resulted in much disruption, but rather some diversions. And it's these two versus demand concerns, especially in China, and ample non-OPEC Plus supply. And we've been kind of discussing these catalysts, and it's been remarkably balanced. One of the questions, and this time around we asked quite a few questions on the BI survey, and respondents, it was about 150 of traders, economists, and strategists that specialize on energy on the Bloomberg terminal, and a big majority of them see a range of $80 to $90 a barrel at the end of this year. So they seem to think that we will remain in this range for a little bit longer. And I tend to agree, unless we see the geopolitical risks that we've been talking about result in a significant disruption of some sorts. I think we will continue to be range bound in this. And I'm happy to talk about some of the other results either now or later on.
Yeah, we'll pick that up. Neil, just to pick up on that, obviously we're in this, as you mentioned, Goldilocks window from a producer's and maybe even from a consumer's point of view to a certain extent as well. the question then becomes, how have we got here? What keeps it in this Goldilocks spot? And then what may change to move it? I mean, ultimately, this is a quieter, typically Q1's demand in the seasonal cycle through the year. Should we not just by natural cycle of global demand growth in the second quarter see an upward lift in prices? Because if they're at this level in quiet demand Q1, should they just not naturally go higher in more demand Q2?
Well, I think the market's already factored that in, because we've got pretty decent visibility of the supply-demand balance in the next few months. I think later this morning, my former colleagues at the IEA will be releasing their latest monthly oil market report, and it's difficult to imagine, I have no inside knowledge here, but it's difficult to imagine that their fundamental outlook is going to change dramatically. So, you know, how we got here? Well, we got here because obviously the OPEC Plus alliance has got a grip to some extent on its own supply. Obviously, you know, we read in the press, the survey shows that they are producing more than technically they should, but that doesn't seem to matter very much. And as for on the other side of the balance, we're seeing pretty strong oil demand. Although, and this is perhaps a pointer as to how things could change later in the year, I've been struck by attending loads of meetings in the last few weeks in Saudi Arabia and then in London at how the consensus seems to be that global oil demand will grow by about 1.5 million barrels a day or so this year, slightly less, roughly that number. But, and I've been banging on about this for weeks now, at the extremes, we've got the IEA saying demand is only going to grow by 1.2 million barrels a day this year, unless they make a change. And on the at the other end of the extreme, we've got OPEC talking about demand going up by significantly more than 2 million barrels a day. Now, if sentiment were to shift, and more importantly, real data were to shift in the next few weeks, either towards the more bearish IEA view or the more bullish OPEC view, then that could shift the dynamic. But that would assume that the OPEC Plus alliance would just sit there and do nothing in reaction to either of those scenarios playing out. So thanks very much to OPEC Plus for doing a pretty reasonable job of restraining their supply. And the global economy, at least certainly led by the United States, is, you know, it's performing under the long-term trend. We know that, less than significantly below the 10-year trend prior to the pandemic. But, you know, growth is pretty strong in the United States, and we must all hope that it picks up in other parts of the world as well. So, you know, we are where we are. We're in this Goldilocks period, as I described it earlier. And I personally think that this Goldilocks period is likely to be extended for some time to come.
Robin, is this, as Neil may suggest, another victory lap for OPEC Plus, or is this a confluent of good fortune? It seems only a few weeks ago with the departure of Angola from OPEC and the difficult meeting that was held in the end of the fourth quarter, that OPEC Plus seemed to be struggling to keep consensus together. Your thoughts on what's underpinning this price, underpinning this stability, and is it another victory lap for OPEC Plus?
Yeah, I certainly wouldn't take a premature victory lap. Look, I think the situation we're in here, Neil lays it out very well, right? There's this wide gap in demand between the IEA and OPEC, and the consensus forecasts are, you know, of others are generally somewhere in the middle of that, perhaps a bit closer to the IEA, but let's say in the middle. And I think it's really crucial, you know, which one of those turns out to be close to the truth. If we get something closer to the high OPEC demand forecast, then prices will probably go up a bit. OPEC can release some of its cuts later in the year, in the second half, perhaps. Prices will go higher, but will moderate. And OPEC is still in a good position, you know, somewhat higher prices, higher output, finally unwinding some of these cuts and easing some of the tensions in the organization. If we're closer to the IEA numbers, then there's a problem, because I don't think OPEC can really cut any more, and we're seeing this already. You know, you mentioned the departure of Angola. Perhaps that's a special case, but Iraq is overproducing right now, and I don't expect it will make up for that. If indeed demand is lower, and OPEC is at the stage where it has to think about further cuts. Who is going to make those cuts? I don't think Saudi Arabia is going to want yet to make yet more of these voluntary cuts and go below 9 million barrels per day. Others won't join them. So that, I think, is if that happened, that's where the danger lies later in the year.
Salah, on that point, I mean, the OPEC sort of the consensus around quotas, Iraq, as Robin mentions, not overproducing. There are some tensions around these quotas, what they are now and what they certainly will be going forward. What has your survey results shown in and around these issues of OPEC plus?
So yeah, I mean, we had a few questions on OPEC, and I'll try to summarize them. I mean, one of the questions was, will OPEC Plus alliance remain in 2025? And the majority thought yes. And actually, a good chunk of them said it will remain as it is right now. And we had other options saying OPEC Plus will remain, but some members might leave. We asked if the OPEC Plus supply management will have to remain for the foreseeable future or forever. And the majority thought from time to time they will have to remain. And quite a few respondents actually thought they will have to remain almost forever. Another question was, will OPEC Plus switch their strategy from the current kind of supporting prices back to market share? And the answer was no, they will not. And the other question was, will there be any more exits from OPEC Plus this year? And this really was 50-50. There was a lot of uncertainty around if there will be another exit following, as you mentioned, Angola's exit last December. So yeah, generally, I mean, the survey results pretty upbeat. And I think the fact that the majority thinks OPEC Plus will remain kind of shows the unity that's expected for the alliance.
Neil, we've had President Putin in Russia speaking over the night regarding this particular point and reiterating Russia's commitment to OPEC Plus and acknowledging that it has delivered the higher revenues that Russia needs. But he did point out in his comments that it also comes at a price of sacrificing market share to the United States, which of course is now the world's largest oil producer and grew quite significantly last year, again up above 13 million barrels a day, new record production there. This idea of market share, the non-OPEC plus, those outside of this restricted agreement can benefit at times like this. Is that likely to put a greater stress on the OPEC plus producers, Russia and Saudi Arabia? Your thoughts on the outlook for that continuing?
Well, a quick response to what Sally said. I'd be very interested to know amongst his respondents, from his respondents, which countries they think are at risk of leaving OPEC or leaving OPEC Plus, because it is a small number of countries, and the only countries that would have any real consequence in the market if they were to leave the alliance would be those countries with significant spare capacity, and there's only a few of those. I mean, we know who they are. Step forward: Saudi Arabia, UAE, Kuwait. Iraq would be going onwards and upwards probably. Angola doesn't really matter. It was underperforming. It's been underperforming for many years, and you can take that on the chin. Now, as far as Russia and Saudi Arabia and the Declaration of Cooperation is concerned, there is no reason to believe that it is going to be brought to a conclusion anytime soon. Almost whatever happens in the market, not quite, but to all intents and purposes, they signed up at the end of 2015, I think it was, and it's a marriage that will continue for many years to come, whether they've fallen out of love with each other or not. And as far as Russia is concerned, yes, you're right. The United States has been able to dramatically increase its production and exports. It's gained increased market share in Europe, amongst other places. But Russia, all things considered, is not in a bad place. Every month, my former colleagues at the IEA publish a great chart in their OMR, which estimates levels of Russian exports in volume terms, which to all intents and purposes are little change from the levels that they had achieved prior to the invasion of Ukraine. Revenues is another matter because obviously prices having soared in 2022 are at more moderate levels now. But even on the revenue front, it's not as if Russia is on its knees. It certainly isn't. And, you know, Russia will continue paying lip service to some extent to the OPEC Plus agreement. Life will go on and the declaration of cooperation will go on. So I don't think we should expect to see any dramatic change in terms of the relationship with its fellow OPEC Plus members anytime soon.
On that point, Robin, we did see as part of that end of year meeting and there's some stresses that emerged seemed to indicate that Russia and Saudi was looking or expressing at least some indications that they weren't happy with Russia's compliance. We had the Russian president come visit Saudi Arabia and the UAE. First time he's left, other than go to China, left Russia since the Ukraine war. That and in the aftermath of that, we also saw Saudi Arabia reduce its OSPs into Asia, where increasingly Russia is competing with the same marketplace there. Your thoughts on that, all of those, the confluence of those issues, and if they are likely to continue to be a challenge for OPEC Plus?
Well, so I think, you know, Neil puts it right where, you know, when he mentions the importance of the Saudi-Russia axis. Yeah, and both countries are gaining a lot from this within OPEC Plus. I don't see any reason why that's going to break down. You know, even if there was significant unhappiness with Russia's performance, which there isn't really yet, then I don't think that they would want the OPEC Plus deal to fall apart. Now, Russia has been successful in kind of completely muddying the waters on what its production cut actually is, because it talks about a production cut, an export cut. Is that a cut in exports of crude or products, or, you know, some mix of both? Well, if it's cutting crude exports, doesn't that mean it's processing more at home? And, you know, so there's no ultimate difference in the market balance. So, and anyway, it didn't fully deliver on its export cuts that were promised. So, you know, that's kind of obfuscated what Russia's actually cutting. But everyone seems to kind of be okay, if not happy, at least kind of accepting of this fudge. In order to keep Russia on board and keep the idea that Russia is participating in cuts in some way, and I think that process will continue. Now, you know, past week or so, we've seen these drone attacks by Ukraine on Russian refineries. You know, those have had some impact on processing levels. I'm not sure they have a big picture impact because they haven't hit oil production, so that oil is coming out one way or another as products or as crude. But still, that also affects kind of monthly product exports from Russia and also its product supply within the country. So that's kind of worth watching, but I don't think it affects the big picture of the OPEC Plus cooperation. No, I think that they'll very much want to keep Russia on board, despite maybe less than full compliance and despite, as you say, the competition in some markets.
Salah, I mean, we talked a lot about this, the supply, that any potential cracks in the supply restraint that obviously is keeping this market supported. But this is a demand issue as well, very much so. We go into the second quarter again. I reiterate that at a time in which we see in the US in particular peak demand for gasoline in the, as they call it, the driving season. In an election year, we have gasoline prices rising. The US government, the administration, not something they're comfortable with. They've intervened before and when prices have got too high. Not that they're anywhere near those levels yet, but it's still early days in this season. Your thoughts on demand side remaining strong in the US and possible intervention there?
Sure, but before I talk about that, just as a very quick response to Neil's points, I think he made a very good point, and this was actually a feedback that we got from a couple of our clients immediately after we put out the survey about which member nation could it be that might want to leave OPEC Plus. So we definitely noted that, and I think we'll have a follow-up question on that in the survey next time. But my guess would be that in a lot of cases, what clients might have been thinking about would probably be some of the smaller members like Equatorial Guinea, Gabon, Republic of Congo. It's similar to Angola, I presume, not big members, not members with a lot of spare capacity and perhaps not as important, but I think they would be thought to be a lot more likely to reconsider the value of the membership rather than some of the bigger members with spare capacity. But again, I think our current thinking is that I don't think countries like the UAE would really consider leaving the group at the moment. But if we are in a place where there is the need for output cuts for a prolonged period of time, I think it is possible that we see some of those tensions within the group grow. If, let's say, we're in 2026 and they still have to bring cuts, the UAE spending a lot of money to increase their capacity even further, I think that would be a difficult position for them to be in. And secondly, very quickly to comment on Russia, because we saw yesterday that they actually increased their crude exports to the highest level this year, despite all the promises. So that hit the wire on the Bloomberg terminal yesterday. So I thought that's worth mentioning. And we did have a question about whether
and
the
yet
US
prices rose. I mean, in that way, that additional supply, Russia continues to perform. It doesn't seem to.
Yeah.
I mean, maybe it's one of the factors that keeps prices from rising any further. The year started with there's lots of supply around, and I think as we come through to the end of the first quarter, that same statement is true. There's lots of supply around. Let's go to the survey question and get a view of this theme I'm sort of driving today. Oil prices to trend higher in Q2 on elevated seasonal demand and sustained OPEC supply cuts. Do you agree or disagree with that thesis? This sort of Q1 doldrums will break out to the upside on the back of seasonal demand growth. Neil, I wanted to get your thoughts on yesterday. Obviously, we also had the announcement of core inflation in the United States moving a little bit higher, but ultimately not lower, and the outlook for rate cuts, rate easing being sooner rather than later. It seems to be drifting further into the future. Your thoughts on what that means for the energy markets? On one side, it has to be somewhat bullish, given that economic performance is still so strong.
Well, yes, you're absolutely right. Economic performance in the United States does appear to be very strong. And as far as the oil market is concerned, then I guess if you're someone looking for bullish oil demand numbers, then you should be very grateful for that. Obviously, things are complicated because this is election year. And you mentioned, I think it was you who said it, forgive me if I got this wrong, that US gasoline prices are going to be a very, very important indicator to watch during 2024. We saw what happened in 2022 in the run-up to the midterm elections when prices were trending higher. Yes, of course, the Russian invasion of Ukraine was the initial catalyst, if you like, for rising prices. But as we moved through the year and crude prices fell back to some extent as the sort of the war sort of settled down, the Biden administration responded very aggressively initially after the invasion, but it maintained its response by drawing down the SPR, for example, throughout the rest of 2022, in my opinion, for blatantly political reasons, once the initial Russian invasion of Ukraine had settled down. And, if for the sake of argument, we were to see a strong US economy, which pulls along some of the other economies in the OECD world and in the wider world, and we were to see some upward price movement, which were to feed into higher prices at the pump for US motorists. As we all recognize that the whole of the oil market exists to benefit US motorists. There's no other reason for it. If we were to see that, then you're going to see some kind of response from the Biden administration. And, that remains to be seen. But you're right, the underlying economic outlook in the United States, joblessness numbers and other indicators, does suggest a pretty tough, pretty strong economy. And yes, that would suggest that further interest rate cuts are not likely to take place too aggressively too soon.
Robin, your thoughts on that? I mean, the demand side of this equation holding up. I mean, we had Jamie Dimon, the CEO of JP Morgan, warning yesterday, recession, the big bad recession wolf isn't off the table yet. I'm just wondering if he was talking up his own book on that. But nonetheless, it still lingers out there, the sort of bearish side, and particularly more when it comes to China. China is on a neutral to negative sort of sentiment narrative. Is that over egging the pudding there, and we're seeing fairly strong import demand into China?
China's really key. Look, I think the US picture is quite strong, as Neil says, that China is really the key. And I think the expectation is, China's going to underperform government targets, but perhaps not by too much. But that's always weighing down the market, and that's certainly helping to keep prices, keep a cap on prices for now. These persistent concerns about China, but a bit of Chinese underperformance, market can take it in its stride. I think what we should watch for is, is the underperformance significantly worse than that? Does the stimulus fail to have much effect? And there is just on all fronts a huge amount of overcapacity in China at the moment, and we've seen, why was oil demand stronger perhaps than it might have been over the past couple of quarters? A big part of that was Chinese petrochemical demand, but there is a lot of oversupply in the petrochemical sector, so the end demand isn't there, and that is a concern. And you see that in metals as well. You see that throughout all the industrial sectors where China is strong, and I think that would be my concern. If China really hits the buffers and all kind of primary commodities, then oil, not just oil but others, are all vulnerable.
And just pick up on the other point, if you would, Robin, the rate outlook. Obviously, we ended the fourth quarter 23 with a massive expectation for 6 or 7 rate cuts, at least market expectation. That is increasingly drifting further and further away, down to possibly 2 or 3 in the second half of the year. Now down to 2, I think, is the market average. Your thoughts on the outlook for that? Does it matter to the energy oil markets?
Yes, it matters in the short term, but these factors are kind of offsetting in my view, because you'll often say, okay, economic news is a bit better than expected, perhaps 1 week, and then the market thinks, well, that means rate cuts are going to be postponed, and so oil goes down. So this is this weird kind of counterintuitive pattern which we've seen actually for months and months now, and that's when the market reacts like that, you think that's clearly narrative driven rather than fundamentals driven. So I think that will persist. And conversely, if inflation does start falling a bit and the rate cuts look a bit more aggressive, you'll see the opposite pattern. But yes, I expect we're going to see it erring to the side of somewhat higher inflation, and some acceptance that's necessary to keep economic growth going.
Salah, last word for you. One of the reasons that we're seeing perhaps a tighter market emerges because U.S. oil majors are not going to be putting a lot of money in the ground this year for new capacity in the Permian like we saw last year. At least that's the expectation, despite the consolidation, or maybe because of it, in we saw last year between U.S. oil producers in the shale patch. But I'm wondering, from your perspective, the outlook for the appetite of the majors, whether European or American, to put more money in the ground to build capacity this year.
Yeah, again, I'll go back to the survey, because we did have a question on the survey asking about the US production growth and whether the impressive growth that we saw in the US shale last year would repeat. And the answer was that it's very unlikely to repeat. The majority expects less than 500,000 barrels per day of marginal growth from US shale this year. But again, I would take what the survey said and what we are saying with a pinch of salt, because we obviously got this very, very wrong last year. We completely underestimated where that growth numbers could be. In terms of majors, very briefly, I know we've already hit the 11 o'clock mark, but very briefly on majors, especially the European ones, talked about this here before, about how, you know, they're really starting to take energy transition seriously. They've started diverting a lot of capital away from the legacy oil businesses into transition businesses. But what we saw in the last year was a little bit of backtracking with those targets. And what we've seen in some of the European majors is they're pushing back some of the peak output expectations for themselves, and they're really, I think, for at least the next few years, they will be diverting some capital back into the oil space. So we could see their output grow for a little bit longer than previously expected, especially for European majors. And we know with the US majors, that's a different story. They have done some mega M&A deals, mega mergers, and they are a lot more confident in oil demand, and they're kind of betting into the oil space a lot more than the European majors are.
Yeah, and they've always been held that. That's been their consistent North Star. Well, the survey indicating a slight agreement that trending higher in the second quarter with seasonal demand growth. With oil prices, as said, Brent up 0.75% today so far at 82.44. Thank you so much, as always, to our speakers. Great to have Neil Atkinson in Paris, of Robin Mills here in Dubai, and Salah Yilmaz also here in Dubai. Really appreciate your insights today and bringing us, Salah, that Bloomberg Intelligence survey. All the best. Have a great day, everybody.
Thank you.
Thank you.
Cheers.